If we take a look at this profit picture, this is a graph of this particular spread, and the profit picture gives us two lines by default. One line, the green line, is what our maximum loss and our maximum profit would be at the expiration of this spread. The current price is right here at $75.20. So you can see that as soon as we put this position on, we have a small loss, and that has to do with the fact that there is the difference between the natural price and the mid price. Every time you put on one of these positions, you're going to have a very small loss as soon as you put it on. The market makers, I guess, have to make a profit somewhere, and that's where they do it, on the spreads. If the price moves in the direction that we anticipate and it goes down, we will make profits as this particular stock moves down in price, because these options will become less valuable and we will achieve a greater profit. If the stock were to move up, since the one that we sold was more expensive than the one we bought, we will be in a losing position. In this, the price of the stock will continue to, if it goes up, our spread will continue to lose money until we've reached our maximum loss of $285. What happens though, see, with the sale of a vertical spread, we get positive theta. Theta is the decay of the option over time that progresses until expiration. Theta will increase in time as we get closer to expiration. And what happens if the price of the stock does not move though, and it stays exactly the same? Well, if you take a look at the graph, if we keep this spread on until expiration, we will achieve a $195 profit, which is right up here. That's one of the advantages of a selling of a vertical spread. The stock either goes in the direction we want it to go in, or it can stay the same and we still achieve a very nice profit. We have two opportunities to profit. Remember, a stock can only go down, it can go up, or it can stay the same. In our case, we win 2 out of 3 times, 2 out of 3 of these chances, because if it stays the same or if it goes in the direction we want it to, we profit. The only thing we don't do is profit when it goes in one direction, up. Now, let's take a look at a regular vertical spread. The purchase of a vertical spread. Let's buy this vertical spread and then analyze it on the same graph. It is exactly the opposite picture of the one that we just had up, in which we sold a vertical spread. Instead of a negative delta, we now have a positive delta, which means that it's positive because the one that we bought is more expensive than the one that we sold. So in reality, each one of these options has its own delta. Well, since we're long an expensive option and we're short a cheaper option, the positive delta that we get from the 75 call is subtracted from the delta of the negative call of the call that we sold short, creating a positive delta. But because we have a positive delta, we also have a negative theta. In other words, remember, there were two scenarios in which we could profit when we sold a vertical spread. If the price stayed the same, we profited, and if it went in the direction we wanted to, which was down, we profited. So 2 out of 3 scenarios we profit. In this case, when we buy a vertical spread, the only possible profit potential that we have is if the price of the stock moves up. In fact, not only does it have to move up, but it would have to move up fairly significantly. In fact, to achieve the minimum that it would have to go up to achieve our maximum profit would be $80 right here. After $80, we continue to receive our maximum profit, but in order for it to achieve the maximum profit, it has to rise by $5 before the expiration date. So it has to do something. If the stock just stayed the same at the same price, we would lose almost our entire investment. Or if it went down against the direction we hoped it would go, we would also lose our maximum investment. So that's the difference really between the sale of a vertical spread and the purchase of a vertical spread. There are only two options in here, and they give you a different profit scenario. The profit scenario for the sale of a vertical spread is that, and let's just switch these around here. We can go sell on this and buy on this, just to show you exactly what happens. If the stock stayed the same or went in our direction, we profit. The only way we would lose is if it goes against us in direction. Again, the delta would be a negative figure, and our theta would be positive. For the majority of the trades that we're making, we want positive theta. We want theta to be positive at all times. And if theta is not positive, then it gives us a sign that we should probably exit our trades or put on other trades that would give us a positive theta. Why positive theta? Well, remember, there's only two truths to the market. Number one, prices will fluctuate, and number two, all options expire. On the whole, if theta is positive, and we go towards expiration, we will collect more and more of the time value of that option to our account.